The market just delivered a masterclass in why consensus trades are the most dangerous positions you can hold. This week, the Fed gave investors exactly what they wanted, a 25 basis point cut with 90% certainty priced in. And the response was a tech rout that wiped out hundreds of billions in market cap, while small caps hit all-time highs. If you're confused by this price action, you're thinking like the crowd. Today, I'm going to show you why this apparent contradiction reveals the most exploitable market dynamic we've seen in months, and how understanding human psychology gives disciplined investors a systematic edge when everyone else is paralyzed by uncertainty. Here's what most traders missed this week. When Oracle reported 66% cloud infrastructure revenue growth and the stock fell 11%, that wasn't market irrationality. That was the market repricing perfection. When Broadcom warned about margin pressure and dragged down every AI name from NVIDIA to AMD, that wasn't sector rotation. That was the unwinding of a crowded narrative that had run out of buyers. The crowd spent 2 years chasing the same momentum trade, and now they're discovering what happens when everyone is positioned the same way and reality delivers anything less than flawless execution. The human layer driving this chaos is textbook anchoring bias combined with loss aversion. Market participants anchored to that 90% probability of a Fed cut, treating certainty as comfort rather than recognizing it as a warning sign that the move was already priced in. When Powell projected only one cut in 2026, not zero, just one, the psychological recalibration was violent because investors had been operating under confirmation bias, seeking only data that validated their AI infrastructure thesis while ignoring mounting evidence of margin compression and elevated spending forecasts. The 3 dissents on the FOMC vote weren't noise. They were signal that even the Fed lacks unified conviction about the path forward. This created a cascade of loss aversion behavior where the pain of potential losses in overextended tech positions suddenly outweighed the pleasure of continued gains. Oracle's earnings miss functioned as a pattern interrupt for the entire AI narrative. Investors who had been cherry-picking data to support their positions were forced to confront disconfirming evidence, and their response was predictably emotional. Flee to safety, rotate to laggards, minimize regret rather than maximize opportunity. At the system layer, this psychological chaos created measurable structural shifts that reveal where the smart money is positioning. The Dow gained 1.2% while the Nasdaq fell 1.9%. A 310 basis point spread that represents the widest divergence in 6 months. The Russell 2000 hitting all-time highs while megacap tech sold off exposed a fundamental reallocation of capital from concentration to diversification. The equal-weight S&P 500 outperforming the market cap-weighted index confirmed that breadth is improving even as headline indices stagnate. Here's the key insight. This isn't sector rotation driven by optimism about small caps. It's defensive repositioning driven by valuation compression and growth. When the S&P 500 trades at 22 times forward earnings, above the 10-year average of 19, there's no margin of safety in the consensus trades. Goldman Sachs up 5% for the week, while Oracle falls 11% isn't contradictory. It's capital flowing to where the risk-reward asymmetry has shifted in favor of the patient investor. The bond market told the same story. Despite the Fed cutting rates, the 2-year yield rose 3 basis points and the 10-year rose 5 basis points because fixed income investors are pricing in higher terminal rates and stickier inflation than the Fed's projections assume. The yield curve steepening signals expectations for stronger growth but also reflects concerns about fiscal sustainability and inflationary pressures from policy changes. The market is telling you that this rate cut might be the last easy one for a long time. The government data blackout created an information vacuum that amplified uncertainty aversion, but here's what the Stoics understood. Markets always operate with incomplete information. The absence of October employment data didn't change the underlying economy, it only changed visibility into that economy. JOLTS showing 7.67 million job openings versus 7.12 million expected suggests a tighter labor market than anticipated, while initial jobless claims spiking to 236,000 added to the confusion. The employment cost index rising only 0.8%. Quarterly provided a disinflationary signal that conflicted with the JOLTS strength. This data confusion paralyzed the crowd, but it created opportunity for those who understand that markets don't reward those who wait for certainty. Certainty arrives only after the opportunity has passed. J.P. Morgan calling consumers fragile activated availability bias, making recent negative data points more salient than the broader trend of economic resilience. The result was a market operating on incomplete information, but forced to act as if it possessed clarity, a recipe for mispricings that disciplined investors can exploit. Now here's the Stoic framework for navigating this transition. The market is moving from a regime dominated by a narrow set of winners to one where leadership is more distributed. This isn't bullish or bearish, it's structural. The AI trade experienced its first major stress test, and many names failed that test, not because the underlying thesis was wrong, but because valuations had priced in not just success but perfection. The exploitable opportunity lies in recognizing that when everyone is positioned the same way, any deviation from perfection creates violent repricing. Broadcom's 11.4% decline on margin pressure warnings triggered $413 billion in ETF outflows from QQQ, forcing passive rebalancing that amplified the sell-off. This mechanical selling created opportunities in quality names that got caught in the technical undertow. Second-level thinking means understanding that the Fed's projection of one cut in 2026 isn't a promise. It's a baseline subject to revision as conditions evolve. The market's reaction, selling growth and buying value, reflects an understanding that the era of abundant liquidity is ending and the era of selectivity is beginning. In this environment, anti-fragility comes not from predicting the future, but from constructing positions that can withstand multiple futures. The disciplined approach is to treat this volatility as feature, not bug. History shows that when consensus trades unwind, they create opportunities in three areas: quality names caught in technical selling, overlooked sectors benefiting from structural shifts, and defensive positions that provide asymmetric risk-reward as uncertainty increases. The crowd reacts emotionally to pattern interrupts like Oracle's earnings miss. We remain disciplined and recognize that when narratives break, new opportunities emerge for those patient enough to let the dust settle and skilled enough to separate signal from noise. The system rewards those who understand that markets are not random but human, driven by predictable psychological biases that create recurring patterns of mispricing. This week demonstrated that pattern perfectly. Consensus became crowded, perfection became priced in, and reality delivered the inevitable recalibration. The question isn't whether this creates opportunity, but whether you have the discipline to exploit it systematically rather than react to it emotionally. What patterns are you seeing in this market transition? Share your thoughts in the comments, and if this framework helps you think more clearly about market psychology, hit that subscribe button. The next few weeks will likely bring more volatility as year-end positioning meets economic uncertainty, and we'll be here to break down exactly how human behavior creates systematic opportunities for disciplined investors.